Okay, we're speaking about current liabilities, and as defined, what is a liability? As it indicates here, FASB defines liabilities as probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So in short, we're taking on a loan, we're taking on a responsibility in order so it can have an economic benefit for the future, right? And I think for me, it's really as simple as things that we even do in life, right? Why are you at this institution? You attend an institution because you want a future benefit. So you're willing to take on loans for the future benefit. You're willing to sacrifice your time and be in class for a future benefit. You're willing to study at night when you would rather be watching TV or doing something else for a future benefit. So a lot of us have a certain type of liability in order to gain a specific thing in the future. I mean, even if you talk about women in pregnancy, right? A woman in pregnancy may feel like it's a liability at that time, but of course it has a future benefit. So as it says here, current assets are cash or other assets that companies reasonably expect to convert into cash, sell, or consume in operations within a single operating cycle or within a year. So again, anything current would be within those 12 months. Okay, so and when it says that companies reasonably expect to convert into cash, so it should be something like a bond. It should be something like maybe a stock that you can sell very quickly. Maybe it's something like coins that you can easily convert into cash, right? So anything that can be easily converted into cash would be considered anything that is current at that time. In this case, a current asset. As it indicates here, current liabilities are obligations whose liquidation is reasonably expected to require or of existing resources. Okay, and within that same period, so within the period is called an operating cycle. So it has to go through the whole cycle in order for it to be considered really a period. So it says a period of time elapsing between the acquisition of goods and services by the final cash realization resulting from sales and subsequent collection. So the whole period from purchasing the item, selling the item, and having the money in your bank account is part of the operating cycle. So here are some good examples of what current liabilities are. Right? Current liabilities, it says typical current liabilities. Current liabilities oftentimes are anything related to accounts payable, notes payable, maturities, short-term obligations. So it can be, obviously it's short-term obligations and not long-term obligations. So the short-term obligations, so say if you have a 5-year loan, year one of that obligation would be considered something current, a current liability, right? Unearned revenues. Unearned revenues are a liability because we have the money, but we're still liable to do something for somebody else. Sales tax payable. Again, that's the sales tax that you collect that you're liable to pay to another person, to another entity, preferably a government entity. Okay. Employee-related liabilities. Again, that would be Social Security, Medicare tax, anything related to sending money to the state. So it's a liability because you've earned that money and it's accumulated, but now you have to give it to the government agency at a certain point. So this is just going even deeper into detail what we just referenced. When we talk about the accounts payable, it says balances owed to others for goods, supplies, or services purchased to open account. As it indicates here, there's a time lag between the receipt of services or the acquisition of title to assets and repayment for them. And that's often because we have several terms of sale here. You have 210, net 30, 110, end of month. Usually state the period of extending credit, commonly 30 to 60 days. So usually organizations are extending credit 30 to 60 days, right? So when I talked about potentially buying into a FedEx type of account, the reason why it looked very favorable to me buying these FedEx territories is because with the FedEx territories, they pay weekly, right? So you can imagine if you're in the trucking industry and you're getting paid every 30 to 60 days, there's a lag time with making money, especially you need to pay the drivers, you need to pay insurance, you need to pay the gas, you need to pay for permits. That's a lot of money to dish out, right? So with that being said, you know, if you have an organization like that that's going to pay you weekly, it would be a lot better. Okay. Notes payable, as it indicates here, written promises to pay a certain sum of money on a specified future date. On a specified future date. So, you know, we're going to be liable to pay X amount at a specific future date. Of course, you can classify them as long-term or short-term. But again, the short-term portion of it would be something called the current liability. As it indicates here, you have interest-bearing note issued. So it says here, Castle National Bank agrees to lend $100,000 on March 1st, 2017 to Landscape Company. If Landscape signs a $100,000 6% 4-month note, Landscape records the cash received on March 1st as follows. So it's saying here you have the cash that's going to increase and the notes payable is going to decrease. So once you pay that payment, your cash decreases. So your cash increases because you received the interest-bearing note, but your notes payable also increases, right? So it ends up evening out as far as your net worth, right? Your net worth is evening out. So now you have a lot of cash in your bank account, but the bank can also see that you have a notes payable, right? So the way that you kind of go through this system is if you could borrow under somebody else's name, but then take the cash and put it in your bank account, it would look a lot better. Because now it shows that you have an increase and that other person has a liability, right? So if you're starting out a business, it would be better. So say if you had a partner, or say if you're married or something, you allow your spouse to take on the loan, but then you would put it on your asset side if you're intentionally keeping things separate, right? The same thing with a partner, right? So when it says the current liabilities, so if Landscape prepares a financial statement semi-annually, it makes the following adjusting entry, right? Because beforehand, it started at March 7th. So March, April, May, June. So that is 4 months from March to June 30th. So if I want to calculate this, going over here, I'm going to say 100 times 0.06. You could put multiply by 4 divided by 12 equals to 2,000. All right, so the interest for that time is 2,000 based on that calculation, based on 4 months. 4 out of the 12 months. So it says at maturity July 1st, Landscape records payment of the note and accrued interest as follows. So you have the notes payable and you have the interest payable, and the total cash that you're going to make a payment to is $102,000, right? This is considerably low in comparison to maybe what loan sharks do. All right, so let's understand first what is a loan shark. As it says here, I'm Googling real quick. Loan shark offers online $500 to $5,000 in minutes. It says here, loan shark, a money lender who charges extremely high rates of interest, typically under illegal conditions. Reports of exploitation and deceptive trading practices by loan sharks. So, and it says, can you bring a loan shark to court? It's illegal to lend money without a license, but it's not illegal to borrow money from a loan shark. You don't have to pay the money back. If the money was lent illegally, the loan shark has no legal right to collect it, and they can't take you to court to get it back. So, oftentimes, if you've seen in the casinos, I don't know if you've seen in the movies, that there's sometimes loan sharks. They lend you money and they expect to get it back. And if you don't give it to them back, then something may happen to you that may physically harm you, right? But also some loan sharks now have created standard agreements, right? So the standard agreement that I had with a potential loan shark, or a money lender rather, was that they were going to lend me $40,000 at 6%. So we just reviewed an example of 6% right before, right? But in this case, it would be 6% per month, not 6% per year, right? So $40,000 times 0.06. It'd be $2,400 a month for the interest, right? And as you can see here, the bank is lending $100,000, 6%, same percentage, but in 4 months it's only $2,000. So if I multiply this by 4 months to only borrow $40,000, that's $9,600 that the money lender would have made, right? So what does this ultimately mean? This means that if you're going to borrow $40,000, then that means that you have to make some use of it. Okay? Have to make some use of it. Okay, so we already reviewed that. Okay. So when we talk about dividends payable, it says amount owed by a corporation to its stockholders as a result of board directors' authorization. So in order to even give a dividend, it has to be approved by someone, right? And if you have if you're a part of the stockholders, they should ask you certain questions. So for instance, I was speaking to people in a nonprofit, and they were saying that these two pastors bought a church, and it's their church. Technically, it is not their church, because once they put it in the nonprofit's name, it becomes the nonprofit's entity, right? So maybe they use some of their funds to buy the building, but technically at that point, once you put it under the business name, it is no longer just your entity. It's the entity of the community. So just in that regard, dividends payable is for everyone, and certain people within the organization have to approve it, right? So it's generally paid within 3 months, right? So then we have being paid every single quarter. Undeclared dividends on cumulative preferred stock not recognized as a liability, right? So dividends that have been undeclared, and if it's preferred stock, it's not recognized as a liability. So normally it would be a liability because we know we're liable to pay somebody else a dividend, right? But what they're indicating here is that if it's preferred stock and it's been accumulating, that it's not recognized as a liability.
So wait, if the company, you're talking about like if there are extra dividends, the company didn't have to pay out because like no one bought them?
Wait, so say that again?
Are you talking, okay, so you're saying like if I invest into a company and sell to the stock market and they pay out dividends,
Yeah.
that company doesn't record that as a liability because, I mean, why wouldn't that be considered a liability?
Only as preferred stock because naturally that money should have been already set aside, like set aside in a special account, because that preferred stock, common stock doesn't have the same value
Oh, yeah.
as preferred stock.
Okay, and when they pull that from some revenue,
Retained earnings?
retained earnings,
Yes. Yeah. So we can say here.
That's they pay dividends out as retained earnings, right? That's how they factor the retained earnings.
Yep.
Now, why wouldn't why would all companies pay out dividends to entice people to buy stock to invest into their company versus only some companies like the big name ones doing dividends?
Wait, that's good question. Wait, let's just read this real quick. Preferred stock is a hybrid between common stock and bonds. Each share of preferred stock is normally paid a guaranteed dividend, which receives first priority. So that's why you want to pay a little bit more to have preferred stock, because you know you're going to possibly get paid. If there's anything left, you're possibly going to get paid first. And why wouldn't they do it to entice other individuals to invest? The reason being is pretty simple. If people keep buying anyway, are you really going to change anything? You're not going to change it, right? So let's think about this in terms of life, in terms of relationships, for instance, right? If you keep treating your partner bad and they keep saying, you know what, I'm going to leave, and they never leave, then ultimately, then you feel like you have the upper hand because you keep talking about leaving and you never leave, but they're still with you, right? So why should I change? There's no reason at all to change because you know that person is still going to be with you, right? So in the same thing as a business sense, people may complain about preferred stock and stuff like this, and maybe it's too much, but where are they going? They're not going anywhere. They're staying.
So is it more or less companies that need help or need that extra money are the ones that are offering dividends and to get more investments?
Yeah, I mean,
so like Sprint, Amazon.
Yeah, they want to pump more money into the system, right? But again, it's kind of corrupt because the leaders on the top understand that the more money that they pump in, their salaries are going to increase significantly and they're going to receive bonuses. So if one of my bonuses was tied to how much we bring in and the stock price, then I'm going to say whatever just to increase that stock price, right? I'm going to try to do whatever just to increase the stock price. You have companies that are merging and they know that within a merge, normally you get an increase in earnings, right? Because now you have two companies and you're putting the forces together.
I also have another question about the stock market too.
Yeah. Mm-hmm.
How does one decide whether, like Amazon, who can go from $1,500 a share one day to $2,200 in one day,
yeah,
versus someone who's just a 30 cent to $1, company?
Yeah.
How do they figure that out? Like, what their share cost should be?
As with anything, we use the example of the iPhone, right? With the iPhone, I remember when we first started this class, we talked about how do we come up with the class with the cost of the iPhone, right? It's whatever somebody's willing to pay, man. So if you're willing to pay $3,000 for a Mac, the Mac is going to be $3,000, right? As soon as people aren't paying for that $3,000 Mac, the price is going to decrease, and it's going to keep decreasing until people purchase it, right? So we're going to put a valuation out there and see if people really buy into it. The same thing that happened with Uber, right? Where they put a price out there, I think it was like $45, and we were trying to see what happened, and nothing really happened. People weren't moved by the $45 valuation.
So is it once they start getting people buying in, that's when they start slowly raising the stock?
Exactly, because now you're decreasing the amount of shares available, right?
Okay.
So now becomes a supply and demand.
Now this is where my question comes into play, because I'm really pissed off myself in the stock market.
Yeah.
I'm investing in this 30-cent company.
Yeah.
Share, or I bought it at 27 cents, and I saw it up to 29 cents, and I figured it's going to do this normal jump up and then drop back down.
Yeah.
So I sold at 29, thinking it's going to drop back down to 27, 26 cents. I'll just rebuy more shares.
Yeah.
And everything, and do day trading.
Yeah.
Well, it jumped all the way up to 50 cents in one day, and like it was a quick jump too. Like it just shot up.
Wow.
So like, does that mean that there was a ton of other people that all of a sudden just bought out of nowhere, like, and pushed us?
Yeah. That's possibly what happened. Yeah.
Because it went up to 50 cents, and then it came, by the end of the day, it came back down to 30
Yeah.
cents. And then it went down. Once it got underneath 30, I bought in again.
Yeah.
And now it's up to 33.
Well, depending upon the shares available, somebody could have
almost 5 million volume in that one day. Like,
yeah. So what could have happened is there could have been some major investors just buying into it. Like you have Wells Fargo stuff, right? They may just be buying into it, and when they buy into it, who knows what can happen, right? Because they're just buying so much of a volume of whatever. We have customer advances and deposits. As it indicates here, returnable cash deposits received from customers and employees, right? So to guarantee performance of a contract or service. So what they're saying is here is that sometimes we receive cash deposits that can be returned at a later date, right? Because it has to be returned at a later date, it is called a liability. Okay, so I know we've seen this before, but the payment received for delivering goods or rendering services. So it all depends what type of industry that you're actually in. So it says here, the airline industry, they have unearned ticket revenue. It's earned when the passenger completes the flight, right? Magazine publisher, unearned subscription revenue. So in month one, they may say that they have the income, but the rest of the 11 months is unearned. The hotel doesn't have the rent revenue until the night is complete, as far as being there for that night. The auto dealer has a certain warranty, right? So if their warranty is for 3 years, they're only gonna recognize the revenue of the first year of the warranty after the first year, right? So they can't recognize it all at once. And the retailers, they have unearned gift card revenue. So laws have significantly changed as far as gift cards, and they're able to last even longer. And all these department stores have a liability because they're liable to give an item to a customer because of the gift card. So another point to consider is the sales tax payable. As indicated here, retailers must collect sales taxes from customers on transfers of tangible personal property and of certain services, and then remit to the proper governmental authority. So as indicated before, you may be going to Walmart, you may be going to the corner store. Whenever they have that sales tax number, is not for their revenue, they actually have to give it to somebody else, another organization.